Hello, this is Brad Harvey with Harvey Investment Management. I'd like to welcome you back to Investing 101, Part 3. This is where we try to put all the pieces together. If you'll remember in Part 1, we talked a lot about definitions. We talked about what is a stock, what is a bond, what is a mutual fund, and what is asset allocation, which is the mix of those investments. How do we put together that actual investment portfolio? We also talked about the law of supply and demand, and we talked about the importance of buying low and selling high, and trying to minimize the emotional responses in all of this. In Part 2, we talked about putting it together and actually opening accounts and buying investments and how that works. We also talked about performance assumptions and again, asset allocation and risk. Now we're going to talk about how does this all come together and how do we know if we're doing it right and how do we keep track of things. The first thing that I would like to discuss is whether or not you should work with an advisor. Obviously, I'm an advisor, so I'm pretty biased on this. I think that advisors have an essential role to play. But if you're going to work with an advisor, do your homework. The first question you need to ask them is, are they a fiduciary? A fiduciary is a legal term, and it basically means that they have to follow the fiduciary standard if they are one. If they are a fiduciary, then they are required to render advice that is in your best interest and to not have any conflicts. What does that really mean? Well, if they're not a fiduciary, they're basically a salesperson, and their job would be to sell you investment products. If they're a fiduciary, their job would be to only deploy investment products that are in your best interest. So if there were two bonds that they were going to recommend to you, and one bond paid them a $100 commission, and the other bond paid them a $500 commission, and the bonds were essentially the same, and they decided, hey, I'm going to sell you the $500 commission bond because I get paid more, well, they cannot do that if they're a fiduciary. They cannot do that and abide by the fiduciary standard. Why? Because it's in your best interest to pay less for that exact same bond. In fact, the vast majority of fiduciaries do not work on commission. They don't get paid money based on which investment products you use. Typically, they're paid as a percentage of assets under management, or they're paid an hourly rate, fee for services types of things, but they do not get paid commissions based on what it is that you are investing in. This becomes particularly important in high commission products like insurance annuities, whole life, things of that nature, certain mutual funds. If they're going to be fiduciary eligible, they don't pay a commission. They don't pay a transaction fee. And typically they don't have a surrender penalty period that you have to own those things to avoid paying substantial costs coming out of them. So don't be afraid to talk to your advisor or potential advisor and ask them if they are a fiduciary. And if they say that they are not, my recommendation is look elsewhere. Because you have to ask yourself, if they're not going to put your interest first, then what are they really doing? They're selling things. It's not to say that salespeople are bad. They're not bad at all. However, if they're working for commission, that can certainly jade their behavior or their judgment. So first and foremost, insist on working with a fiduciary. The next thing you want to ask them is, how do they get paid and how much? That is not an uncomfortable question for professionals. You expect for them to make money, they expect to make money, you expect to get value for what you're paying, and you expect to know what it is that you're paying for. If they won't answer that question about what they're being paid and how much and how it works, then again, look elsewhere. Then the last thing that I want to talk about in terms of working with an advisor and working with professionals, try to avoid any investments that have limited liquidity. In our industry, we call that regular way settlement. What does that mean? If you were going to buy a stock or going to sell a stock, it settles in 2 trading days. So if you sold it today for $10,000, then in 2 trading days, you'll have that cash in your account. If you bought a stock for $10,000, in 2 trading days, that money would leave your account and the stock would be delivered into your account. There are lots of investments out there that have limited liquidity, which means you cannot sell them. Lots of hedge funds are this way. There are some non-traded REITs out there that do not trade on public exchanges, so they can be extremely difficult to get your money out if you need it. So insist on regular way settlement. Avoid limited liquidity investments unless you know precisely what it is that you are getting. So, Work with fiduciaries only. Know what you're paying for. Know how they're going to get paid. If they're not fiduciaries, look elsewhere. This becomes particularly important in high commission products. Those tend to be centered around insurance, so annuities, whole life, things like that. Again, it's okay to know what are you paying. So if you go buy a policy that has a $100,000 a year premium for whole life, that agent may be getting $50,000 or $70,000 a year of that 100 as a commission. I'm not saying that's high or low. What I'm saying is you need to know that. Another good idea is to take the advisor's name or the agent's name and look them up on BrokerCheck.com. This is a service by the regulatory industry for securities and investment brokers and professionals, and it tells you what their licenses are, how clean is their background. That's not to say that there may or may not have been complaints against an advisor and it's good or bad. You just need to know. If they were convicted of fraud and they're still in the industry, you need to know that. Go in with both eyes open. So BrokerCheck.com is a free resource. You can look at it online. You can also do a simple Google search on the advisor's name. Be informed. So moving on, let's talk about putting it all together. In the last series, we talked about asset allocation, and we talked about basic return assumptions. So stocks 10%, bonds 5, round numbers, inflation 3, round numbers. We talked about US versus non-US, small, medium, and large, and so forth. We talked about bonds and how you can look at treasury bonds and tax-free bonds. Corporate bonds, there will be credit ratings that will tell you if it's AAA, which is super good, or single B, which is high yield or junk bonds. You want to know what it is that you own and what is your expected return. When you put together your asset allocation, let's say you put 50% of your money in stocks and you put 50% of your money in bonds, then your blended expected rate of return, all things being equal, and I'm trying to keep this very simple, would be 7.5% per year. Now, if you want to drill down a little further and say, okay, well, my stock exposure is 100% the S&P 500. Okay, then that 50% that you put in stocks, we're going to benchmark against the S&P 500. For your bonds, if you put 100% of your bond exposure in 10-year US Treasuries, and that index is the 10-year Treasury index, then 50% of your benchmark for tracking purposes should be the 10-year Treasury index. So that puts together a reasonable way to track how are we doing for the exposure that we have. The other thing that you can do if you didn't want to deal with market benchmarks and things like that, you can benchmark against the inflation rate plus a spread. We call this a nominal return. So if you're trying to get toward retirement and you say, you know, I just need to beat the inflation rate by 3% per year and then I'll be able to retire on time in 20 years. Well, then you can plug in the CPI, remember that's the Consumer Price Index, plus 3% as your benchmark. So if inflation is 3 and you add your 3% to it, you wanted to do 6% that year. That's not a bad way to benchmark and determine how you are doing. You want to take a look at these numbers at least on a semi-annual basis or a quarterly basis, certainly no less often than once per year, to determine is your performance consistent with your goals. And while you're doing that, take a look at your risk. Okay, if your risk, you are 80% exposed to the stock market and the stock market had a great year, maybe we trim back a little bit. That talks about rebalancing. There are two basic methods of rebalancing. One is a calendar basis. I like to use your birthday because it's easy to remember. Another is basic economic conditions. If we're in a recession, which is defined as 2 consecutive quarters, so 2 3-month periods, where our economy actually got smaller or contracting GDP. GDP is gross domestic product. That's everything we create every year, goods and services. If that number is getting smaller, then we're heading into a recession potentially, and so maybe we want to make adjustments based on that. Those are economic conditions that can trigger rebalancing. Or maybe you want to rebalance every 3 months, which is every quarter, or every 6 months, or every year. And if your goal was, hey, I want 60% in stocks and 40% in bonds, then every 3 months you buy some things and sell some things to get back to that percentage. Now, there can be a downside to this. In some portfolios, you have to pay transaction costs to buy and sell securities. So if you're only buying or selling one share of something and it costs you $50 to do that, well, that might not make sense. We may not want to rebalance because the cost doesn't really justify the benefit of the rebalance. The other thing to keep in mind is taxes. Sometimes if you do a rebalance and you've held something for less than 12 months, it's a short-term capital gain or loss, whereas if you waited another month, perhaps it turns it into a long-term gain or loss. So taxes can certainly be impacted by your rebalancing behavior. I'm not a tax expert, but I think it's very important to keep that in mind. So as you're putting it all together, first determine whether or not you should or want to be working with an advisor. Make sure they're a fiduciary. Find out exactly what they're charging and how much and what are you getting for those services. Then move on to benchmarking. As you put together your investments, how are they doing based on what their peers are doing, which are indexes? And how are they doing, more importantly, based on what your needed return is to reach your goals? So with some basic financial planning and forecasting, you can come up with what your required rate of return is to get you to retirement, for example. Then take a look at that at least on an annual basis to determine whether or not you are ahead or behind the curve. If you're behind the curve, perhaps you should change your risk profile and your investments to get a higher rate of return. Or maybe you need to add more money. Or maybe you need to change your goals where you work a little longer. If you're ahead of the curve, maybe we pull back the risk. Maybe we decide, no, I'd rather retire another year earlier, or perhaps we start putting in less money. Remember, this is a plan over time. There will be changes. That's part of the process. Be ready for that. Change is your friend, not your enemy. This is Brad Harvey. Thank you for tuning in to Investment 101 Part 3. We hope that you've enjoyed this presentation.